So, what if you could pull in a steady, predictable income from an asset that famously pays zero dividends? Well, today, we're tearing down the walls on the digital credit strategy. It's a pretty slick method for seasoned investors looking to generate some real, actual yield from Bitcoin. Let's get right into it.
I mean, that's a statement that makes you stop and listen, right? Getting consistent, dividend-like cash flow from Bitcoin. It sounds like it shouldn't be possible. But that's the whole promise of the strategy we're about to unpack. So the real question is, how on earth do they do it?
Okay, here's how we're going to tackle this. First, we'll lay out the big problem with Bitcoin for any income-focused investor. Then, we'll decode the solution they call digital credit. After that, we'll dive into the numbers behind that juicy yield, get into the nitty-gritty of the strategy and its risks, and then wrap up by asking, hey, could this actually fit inside a long-term pension portfolio?
Right, so let's just start with the fundamental paradox. Bitcoin, by its very nature, doesn't spin off any income. It's not a stock that pays a dividend. It's not a bond that pays interest. So if your goal as an investor is to generate cash flow, well, you've got a massive problem to solve right out of the gate. And that, right there, is the investor's dilemma. And I love how it's put here. You've got this asset with incredible potential, but how do you actually make it pay the bills? How do you get reliable cash flow from it? Especially when you're dealing with what the source material just calls freaking annoying volatility. And let's be honest, that's a perfect description. This is the very problem that digital credit is designed to fix.
So what's the secret sauce? It's a strategy called digital credit. And the beautiful thing about it is that it's not some crazy new invention. It's really just taking a classic, time-tested financial idea and applying it to a whole new world of assets. So, what exactly is digital credit? Well, the textbook definition says it's a strategy where you generate yield by issuing credit that's fully backed by a digital asset, in this case, Bitcoin. Your income, your so-called dividend, comes from the premiums that other folks in the market are willing to pay you. Now, if you come from a traditional finance background, this should ring a bell. The absolute easiest way to wrap your head around digital credit is to think of it as a covered call strategy. It's just like what you do with Apple stock, but you're doing it with Bitcoin. You own the Bitcoin and you sell someone the right, but not the obligation, to buy it from you at a higher price down the road. For selling that right, you collect a premium in cash right up front. And that premium, that's your income.
All right, let's talk numbers. Because the theory is cool, but how does this actually translate into a real, tangible yield that hits your account? So the headline number, the target we're looking at, is a whopping 10.75% annual yield. In today's market, that is a number that definitely gets your attention. So we have to look under the hood and see how it works.
So how do we get to that $1,900 a month? Let's just walk through the math real quick. You start with a portfolio of, say, around $212,000. You apply that target annual yield of 10.75%, and that gives you an annual income of about $22,800. Just divide that by 12 months, and boom, there's your $1,900 a month. The math itself is straightforward. The engine powering it all is those premiums you're collecting. Now, this is absolutely crucial, so let's talk about investor protection. This isn't just some unsecured loan out in the wild. Every single dollar of credit that's issued is fully backed by the underlying Bitcoin. We're talking a strict one-to-one collateralization ratio. That is the core safety mechanism that secures the whole position and protects your capital. Okay, so the theory sounds great, right? The numbers look compelling, but how do you actually do this in a real portfolio? And maybe even more important, how do you manage the risks that obviously come with it? Well, to actually put this strategy to work, investors typically use exchange-traded products, like the tickers STRC and BTCI. Now, they both use this covered call approach, but they're not identical. BTCI, for example, has been around longer and usually has higher trading volume, which means its liquidity profile is a bit better. It's easier to trade in and out of. STRC is the newer kid on the block, and it's structured a bit differently to capture a different slice of the volatility premium. Your choice between them really comes down to your own needs for liquidity and what kind of risk exposure you're comfortable with. Look, no strategy is a free lunch, and this one has 3 big risks you have to keep your eye on. First, you've got that freaking annoying market volatility of Bitcoin itself. Can't ignore that. Second is counterparty risk. That's the risk that the person on the other side of your trade just disappears. And third is liquidity risk. Basically, can you get your money in and out when you want to at a fair price? So, how do you manage these risks? This is where the strategy gets really clever. To handle the wild price swings, it uses active hedging.
For instance, while you're holding Bitcoin, you might also short a futures contract against it. The goal is to make your position price neutral. So if Bitcoin's price tanks, your hedge makes money, canceling out the loss. This allows you to isolate and pocket the income from the premiums without actually betting on which way Bitcoin's price is going to go. It's pretty smart.
And let's be really specific about that counterparty risk. See, when you trade derivatives over the counter, or OTC, you have direct exposure to the institution you're trading with. If they go bust, you could be in trouble. But here, by using exchange-cleared instruments, the exchange's own clearinghouse acts as the middleman for every single trade. They guarantee the trade. This centralizes the risk and dramatically reduces the chance of a single counterparty default wrecking your position. It's just a much, much safer structure.
All right, let's zoom all the way out now and think about the big picture, the long-term view. Could a strategy like this actually find a place in the most conservative portfolios out there? I'm talking about things like pension funds.
This really is the multi-trillion-dollar question, isn't it? For literally decades, pension funds have built their income strategies on a foundation of bonds and dividend-paying stocks. But as those old reliable sources face new challenges, the big money managers are hunting for alternatives. Could digital credit actually be one of them?
When you look at it, the potential advantages for a pension are pretty compelling. First, you get a new source of yield that isn't directly tied to what the central banks are doing. Second, the income stream is potentially non-correlated to stocks and bonds, which is kind of the holy grail for portfolio managers. And third, if you put this inside a tax-advantaged pension wrapper, you could compound these high yields for years without taxes eating away at your returns. Now, of course, the big hurdle is still the newness and the perceived risk of Bitcoin itself.
And that leaves us with one final, pretty provocative thought to chew on. For years, big institutions have really struggled with crypto. They don't know how to classify it. It's not really a currency, not quite a commodity, and it doesn't pay a dividend. But what if structured products like these, the ones that create predictable, income-generating instruments from crypto, are the key? Could this be the bridge that finally allows crypto to be seen as a mature, institutional-grade asset class? That's a question that could really redefine portfolio construction for decades to come.